Hello and thank you for checking out today's market update video. Today is Friday, October 18. It's about 1:30 p.m. So about 2.5 hours until the end of the trading day and also the trading week. It's been a pretty interesting couple weeks since my last market update video. Fortunately, a lot of things have been holding true to form. This chart that you see right now is an S&P 500 daily chart. It's probably the most common chart that I show in my market updates. And for those who haven't seen it before, what this is showing is each bar represents a day. When you see kind of a white colored bar, that's a positive day in the market, and the red colored bars are the negative days. I've continued to leave some lines drawn on these charts that I've had from really the past couple of years. The blue horizontal lines you see kind of moving from the lower left to upper right, that was the market rally that started late in 2012 and it continued up until late May of 2013. It was a really nice channel, they call that, where the market would really just kind of bounce between two ranges in that parallel channel. The reason why it broke out to the bottom, that was back in May when Ben Bernanke, the Fed chairman, made the announcement that they may start tapering their purchase of long-term bonds. And it sent the market for a short little downward spell, but pretty modest, really, only about, looks to be about a 4.5 to 5.5% sort of drop. And the announcement, really, the reason why it spooked the markets a bit was because for the last really year now, a lot of the reason why the stock market's done well is because the Fed has been buying long-term bonds, which drives down interest rates. They also have been buying a lot of mortgage-backed securities, which creates liquidity in the mortgage market. That helps the real estate market go up, of course, because the more people who can afford to buy homes, really the better that is overall for the economy. And more people can afford to buy homes when there's access to money, so loans are pretty easy to get, and the cost of borrowing that money is pretty low. And it really goes more than just mortgages. That's a big piece of it, but it impacts really the entire financial market. Now, shortly after that decline, the Fed had made a couple of announcements that, whoa, hey everybody, don't panic. We said that we might start tapering later this year. Of course, we found out that the Fed has not chose to do any tapering. That started a new channel, and those are the two red horizontal lines you see. And this has been going on now for about 5 months, and it looks to be holding true to form just like the last upward channel. Now, there is a difference. This channel, the range is wider, so you can see that the two bars are further apart. So the rallies seem to be bigger and the declines seem to be bigger than what we enjoyed for about 6 months from November 2012 till May of 2013. But it still is holding true to form. The market went up, hit a peak, went down, hit sort of a low, then hit a new high, then hit a low. The consistent theme here, and we'll see this across both of these two channels, is that every time the market sold off and went to a low value, that low has been higher than the previous low. And we can see that going all the way back to November of 2012. So every time there's been a low, so if we look at like each of these little sell-offs in the blue bar, each time it stopped and went up, that low was higher than the previous low. The other consistent thing is that the highs are higher than the previous highs. So we have higher lows and higher highs. That, folks, is a bull market. So it's been a pretty strong bull market. And what we're experiencing right now, the last 3 days have been pretty good. Really, the last 2 weeks have been pretty solid. Since the market hit its most recent low, again repeating the pattern it's been having for about a year, which is this low is higher than the previous one. And then this ensuing rally has now put us at a new high, higher than the previous high, which was kind of mid-September, about a month ago. What I believe will happen is we'll continue to trade in this channel, perhaps. Obviously, the channels don't last forever. You can see that between the blue channel and the red channel here. But they tend to last for quite a while until there's news that breaks the trend. So there's a saying in financial markets that news trumps trends. That's why the last trend was broken, the news from the Federal Reserve. We'll see what the next news is. Part of what happened to inspire this latest rally is the whole concern about a debt ceiling turned out to be just a lot of hot air. We have a lot of folks arguing about should the debt ceiling be raised or not. Personal opinions on this aside, It's not like we haven't had debt ceilings before. A lot of us remember debt ceiling talks last year and debt ceiling talks the year before that. The reality, I think, in the United States right now is that we're borrowing a lot of money and spending a lot of money. And collectively, the Republicans and Democrats have decided that they're going to continue to do that. They might bicker a little bit, but nobody's really put their foot down until that debt ceiling is actually adhered to. I mean, I suppose that's the whole point of a debt ceiling, is that it's supposed to be the maximum amount of money you can borrow. But until you adhere to it, it really is quite meaningless. I mean, they just keep raising it and raising it. But the markets like that news. They said, hey, we don't have to worry about this for a while. So since there's nothing to panic about, people started buying stocks again, and it drove the stock market higher. Since the Fed has not actually done their tapering, we see the bond market going higher. It's still not as strong as the stock market, and it is still negative for the year. But if I go down here and pull up a chart on the bond market, you can see it's a little different chart. This is one that is a weekly chart, so it's showing about 5 years of history. We can see the decline back in May. It was about a 5% drop from peak to trough for the bond market. The bond market's slowly kind of coming back. So bonds are still down a little bit from their highs this year, but all of the scare about bonds losing all of their value because interest rates would spike like crazy seems to have been a little bit premature. It'll be curious to see where the dust settles on the bond market for the year, but it's starting to look like it'll just be a flat year. In spite of interest rates rising a little bit, the yield of the bonds themselves has been equal roughly to the actual decline in price. So again, we still have about a month and a half left, but it certainly doesn't look like the huge scare where there was this big 5% drop. And of course, if you annualize a 5% monthly drop, it is very, very scary. It turns out anybody who panicked and sold there and decided they didn't want to have anything to do with bonds ended up looking a little bit silly and having some egg on their face. Bonds have since recovered about 2%, and so they still have a little ways to go to get back to their highs, but this is not the first time it's happened. When we look back in history, we can see that there's plenty of times where the bond market drops 2, 3, 4, 5%. I do feel, it's sort of stating the obvious. Interest rates do have to go up, but it's sort of like, when will they go up, not if they'll go up. And they might not go up in a meaningful way for quite a while unless the Federal Reserve changes the overnight rate and intentionally lets interest rates go higher. This is a lot like the stock market. When we look at the stock market, it's not a question of if it will go down. I mean, eventually it has to go down. Markets don't go up forever. This one's been pretty strong for about 5 years. And we know that historically a bear market comes along every 3 to 5 years. So, sort of common knowledge would be that we're due for a bear market, but it doesn't mean that it has to go down every 3 to 5 years. It could continue to go up, maybe for 3 more months, maybe for 3 more weeks, maybe for 3 more years. It's really hard to say. The important thing is to keep a close eye on these types of things, and hopefully that's what you all are doing by watching these market update videos. When the times are good, it's important to make sure that we're at least mostly invested and enjoying the good times. Even if we are a conservative or balanced investor, it's important to stay with that conservative or balanced approach, even when sometimes it feels like we shouldn't. Of course, what we've seen these last few weeks really validates that. I know, speaking personally, I have a lot of contact with clients. We had a lot of folks really concerned around May and June. Markets for especially conservative folks were not so good. If we had a lot of bonds or fixed income in our portfolios, if we had international holdings or commodities, there were a lot of things that were negative year to date, halfway through this year, and about the only thing that was doing well was the U.S. stock market. Over the last couple of months, we've seen that change a little bit. U.S. stocks are still good, but a lot of other asset classes are starting to come around. In fact, the last couple of months, foreign stocks are starting to outpace U.S. stocks by a pretty good margin. So having that nice balance that was really painful to have the first 6 months of the year is starting to pay some dividends now. And I think that what will happen in the future is we'll see that sort of change of the guard. The U.S. stock market will not be the greatest market in the world forever. Eventually, there'll be some other investment asset classes that end up being the leaders. And those who got too hot and heavy into just U.S. stocks, in other words, they invested with the benefit of hindsight, just buying last year's winner, they're going to unfortunately suffer some really poor results. Whereas those who stay committed to a diversified, balanced approach, maybe favoring being a bit more conservative, should find that they do very well looking into the future. So that's about it for today. Good news is there's not a whole lot of news. Times are okay. There's still some reasons that we need to be cautious, namely that when things go up and up and up, it does tend to create bubbles, so we'll have to be on sort of a bubble watch, if you will. But it's not a time to panic. It's certainly a time to enjoy a couple percent gain over the last 30 days. And if there's any things we start to see that are really worthy of paying especially close attention to and getting really defensive, of course, I'll let everybody know with some blog updates here. Again, this is Jason Wink. Thank you very much for checking out today's market update video. Hope everybody has a wonderful weekend, and I'll likely be back in touch next week.